What's up, traders, and welcome to another installment of the Market Barometrix Technical Analysis series. In today's video, we're going to be talking about the Relative Strength Index, or the RSI. Now, the RSI is a technical indicator, an oscillator, in fact, that's going to give us a reading of price momentum. We can use it as traders and investors to identify attractive entry and exit signals, and to confirm the strength of prevailing price trends. Without further ado, let's jump in and learn a little bit more about RSI. On deck for today is the Relative Strength Index. Now, this is a technical indicator known as an oscillator because it has a value between 0 and 100. And it measures the magnitude of recent price movements relative to recent price highs and price lows to provide a gauge of overbought and oversold price levels. The calculation for RSI is fairly simple. It begins with a look back period. Usually the default is 14 days. So it's going to look back at the most recent 14 close prices, and it's going to take the average of the gain on up days and the average of the loss on down days, and it's going to do some fancy math to put that value on a number between 0 and 100. What this is going to provide us is a gauge of the relative strength of the price momentum, with a value above 70 indicating overbought levels and a value below 30 indicating oversold levels. So not that important for you guys to memorize the calculation, but just remember that it's a price momentum indicator, and it's going to be a value between 0 and 100. A value above 70 indicates overbought levels. A value below 30 indicates oversold levels. All that said, let's jump into the Market Barometer and have a look at the RSI in action. Alright, so I'll go ahead and add the RSI using the Indicators button here. We'll scroll down to Relative Strength Index, and easy as that, you see that it gets added as an indicator below our price chart here. Also, in the top left of the RSI section, you can see the settings. Now, it's going to default to a 14 period look back and to overbought and oversold levels of 70 and 30 respectively. Now, this is totally customizable in the settings here. You can change the look back period and you can change the overbought and oversold levels, but I typically just use the defaults because this is going to do a good job of giving us all the information we need. So the most basic way to read the RSI is to just look for overbought and oversold levels. So on this time frame, we actually reached overbought levels twice, once in late August and again in early September. Now, both of these overbought readings ended up providing a pretty good signal that the market was overbought and due for a correction. Now, the first overbought reading here in late August was something of a fake out because instead of price correcting right afterwards, it consolidated for a few days, meaning that in a way it digested the recent move higher and led to another push higher in the market. This second push higher, however, was met by an even more extreme overbought reading in the RSI. And this push higher in price ended up being an exhaustive push higher and did finally lead to a big correction in price. And you can see that the overbought condition in the relative strength index also was relieved as price moved down. Now, something that I find really important to consider when you're assessing price momentum in regards to RSI is to consider the overall prevailing price trend. For example, if you're in a prevailing long-term uptrend in price, overbought RSI levels are less likely to indicate to you major price corrections. Also, in a long-term prevailing uptrend, the RSI can remain at elevated or even overbought levels for a lot longer than it may otherwise be able to. And the same is true in reverse. So if you're in a long-term prevailing downtrend in price, oversold levels in the RSI are less likely to indicate a price reversal higher. The RSI can also remain at depressed or even oversold levels for a lot longer than it may otherwise be able to. And generally, in the context of a long-term trend, trend, overbought and oversold levels will need to get even more extreme than the 70 and 30 marks to be good indications of price reversals. And we can see that here to some degree being demonstrated in late August and early September. That first overbought level happens within a prevailing longer term price uptrend. And instead of price correcting afterwards, it consolidates for a few days. But then when price pushes even higher and that overbought level in the RSI gets even more extreme, it finally does lead to a significant reversal in price. One last point I want to touch on is the concepts of positive and negative divergence. Now, if you've already watched our video on the MACD indicator, you might be familiar with the concept of divergence, but it's also applicable to RSI. Positive and negative divergence refers to times when a technical indicator is moving in contrast to the market. So it's trending in the opposite direction of the prevailing. Now, when RSI negatively diverges from an upward move in price, this is indicating to us that maybe the short-term momentum of that price move is drying up. Conversely, if price is trending down, but the RSI begins to trend up, that might happen in anticipation of a reversal higher in price. So we do have a tidy little example of a negative divergence in the short term on our price chart here. And you can see that developing in mid-July, where RSI fails to make a new high in this 12-day range or so, while price, on the other hand, over the exact same time frame, does make a new high. So here we see price trending up while RSI trends down. And sure enough, that did lead to a short-term price correction. Now, again, we're in a prevailing uptrend here. So while this does lead to a short-term price correction, the prevailing trend remains intact. Now, when we find divergences like this, not only are they good indications of likely price reversals, they also provide us really obvious places to put stop losses. So in our example here with this negative divergence in RSI and price moving higher, if you had been looking to put a short trade on, seeing this negative divergence develop would have provided that signal for an entry point for a new bearish position. In addition, what we could have done is set a stop loss on that new bearish position equal to that high in price. So if our stop loss had been here around the 1593 mark or so, and we had put on a shorter term position, we would have done really well. And in fact, it took price nearly a month to get back up to that level where we would have placed that stop loss. Now, you may be looking at this chart and saying, Neil, why wouldn't you extend this divergence back this far? Because it would seem that this divergence is happening on a longer term scale. Well, you'd be right, except for the fact that RSI is only looking back 14 periods. So the level back here in early June is not going to be very relevant to where the RSI is here in the middle of July, 40 or so periods later. So you have to keep that in mind with the RSI and however you customize it. So I typically stick to the default of a 14 period look back, but keep that in mind whenever you're drawing divergences and drawing conclusions from those divergences. To that end, RSI can be used on a longer term scale, and that has to do with the time frame of the chart that you're using. So right now we're looking at daily candles and daily readings in the RSI. If we come up here and change this from a daily reading to a weekly or monthly reading, well, now that 14 period look back is going to be 14 weeks as opposed to 14 days. So we still have to be thinking about the fact that, the RSI is only going to be considering the last 14 periods, but now it will be looking at 14 weeks instead of 14 days, giving us a longer term horizon. And obviously you always have the option to just adjust the look back period to extend this out to more days or more weeks, or whatever you think is going to be most applicable to the type of analysis you're trying to perform and the time frame that you're trying to perform it on. There you go, folks, the Relative Strength Index, or the RSI, which is another of our favorite technical indicators that's going to give us a reading of price momentum. We can use it as traders and investors to identify attractive entry and exit points by way of the overbought and oversold readings, as well as to identify areas of positive and negative divergence. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.